Hey everyone, welcome back to my channel. I'm thrilled to have you here today for what's going to be an eye-opening journey into the world of trading markets. Whether you're a seasoned trader, a curious beginner, or someone who's always wondered what all the fuss is about when you see those frantic stock market scenes on TV, this video is for you. Today, we're diving deep into 10 absolutely mind-blowing facts about trading and the markets that make it all happen. Trust me, by the end of this video, you'll see this fascinating world in a whole new light. So, grab your favorite beverage, get comfortable, and let's embark on this exciting exploration together. Before we jump in, if you find value in this content, please don't forget to hit that like button. It really helps the channel. And if you're new here, consider subscribing for more insights into the world of finance and trading. All right, let's dive into these jaw-dropping facts. Fact number 1. Let's kick things off with a journey back in time. Did you know that the concept of trading isn't just old, it's ancient? In fact, trading dates back thousands of years to the early days of human civilization. Long before the invention of money, people engaged in what we call the barter system. You're living in ancient Mesopotamia, and you've just harvested a bumper crop of wheat. Your neighbor, meanwhile, has more sheep than they know what to do with. So, what do? You trade? A sack of wheat for a woolly sheep is the essence of bartering. This system wasn't perfect, of course. What if you needed wheat, but the wheat farmer didn't need what you had to offer? This coincidence of wants problem eventually led to the development of commodity money and, later, the currency systems we use today. But make no mistake, every time you buy stocks or trade Forex, you're participating in a tradition that's as old as civilization itself. Fact number 2. Now, let's fast forward to today. If our ancient ancestors could see modern trading, they'd think they'd stepped into a sci-fi movie. We've come a long way from bartering sheep for wheat. Today, we live in a digital age where trading happens at the speed of light, literally. Here's a mind-boggling fact. Electronic trading now accounts for a whopping 90% of trading activity in major markets like the New York Stock Exchange, NYSE. That's right, folks. The vast majority of trades aren't made by humans shouting orders on a trading floor. Instead, they're executed by supercomputers running complex algorithms. These algorithms can analyze market conditions, news events, and countless other factors in microseconds, making trading decisions faster than any human possibly could. Some of these high-frequency trading systems can execute thousands of trades per second. It's a far cry from the days of ticker tape and phone orders. But don't worry. This doesn't mean human traders are obsolete. In fact, the rise of algorithmic trading has created new opportunities for skilled traders who can develop and manage these systems. It's just another example of how the trading world is constantly evolving. Fact number 3. Speaking of evolution, let's talk about the biggest player in the global trading arena. When most people think of trading, they picture the stock market. But here's a shocker. The largest trading market in the world isn't the stock market at all. It's the foreign exchange market, better known as Forex. Every single day, over $6 trillion is traded in the Forex market. To put that into perspective, that's more than all the world's stock exchanges combined. Unlike the stock market, which typically operates during set business hours, the Forex market is open 24 hours a day, 5 days a week. This massive, round-the-clock market is where the world's currencies are traded. Every time you exchange dollars for euros before a European vacation, you're participating in the Forex market. But most of the activity comes from banks, corporations, and professional traders who are constantly buying and selling currencies for profit or to hedge against currency fluctuations. The sheer size and constant activity of the Forex market make it an attractive space for traders. With so much money changing hands every day, there are always opportunities for those who know how to spot them. But remember, with great opportunity comes great risk, a theme we'll revisit later in this video. Fact number 4. Now that we've talked about the Forex market size, let's dig into something a bit more technical but equally fascinating. Did you know that not all currency pairs are created equal when it comes to trading? That's right. Different Forex currency pairs have vastly different liquidity levels, which can significantly impact how they trade. Let's break this down. In the Forex world, liquidity refers to how easily a currency pair can be bought or sold without causing a significant change in its price. The more liquid a pair is, the easier it is to trade in large volumes without moving the market. The most liquid currency pair in the world is EUR/USD. That's the euro versus the US dollar. This pair accounts for about 28% of all Forex trading volume. It's so liquid that you can trade millions of dollars worth of euro to US dollar without significantly impacting the price. On the other hand, you have what traders call exotic pairs. These might include combinations like the South African rand versus the Japanese yen, ZAR/JPY. These pairs are much less liquid, which means they can be more volatile and more challenging to trade in large volumes. Why does this matter? Well, if you're looking for stability and ease of trading, you might stick to major pairs like EUR/USD. But if you're after more excitement and don't mind the additional risk, those exotic pairs might be right up your alley. It's all about finding the right balance for your trading style and risk tolerance. Fact number 5. All right, let's shift gears and talk about the new kids on the block: cryptocurrencies. These digital assets have taken the financial world by storm, and their story is nothing short of incredible. Here's a fact that still blows my mind. Bitcoin, the world's first and most famous cryptocurrency, was launched in 2009. When it first appeared, it was essentially worthless. Early adopters could get hundreds or even thousands of bitcoins for just a few dollars. Fast forward to today, and a single bitcoin has reached peaks of over $60,000. This astronomical rise has created some unbelievable stories. There are tales of early Bitcoin owners who became millionaires almost overnight, and equally, stories of people who lost fortunes by misplacing their Bitcoin wallets or throwing away old hard drives containing thousands of Bitcoins. But Bitcoin is just the tip of the iceberg. There are now thousands of different cryptocurrencies, each with its own unique features and potential uses. This new asset class has introduced a whole new level of volatility to the trading world and sparked intense debates about the future of money and financial systems. Love them or hate them, cryptocurrencies have undeniably shaken up the trading landscape. They've attracted a new generation of traders and investors, forced regulators to grapple with new challenges, and even led some countries to consider launching their own digital currencies. It's a space that continues to evolve at a breakneck pace, and I for one can't wait to see where it goes next. Fact number 6. Now, let's talk about something that's changed the face of trading in recent years: the rise of app-based trading. This technological revolution has democratized trading in ways that would have been unimaginable just a couple of decades ago. Platforms like Robinhood, eToro, and many others have made it easier than ever for anyone to start trading stocks, cryptocurrencies, and even complex instruments like options. With just a smartphone and a few dollars, you can now buy fractional shares of companies like Amazon or Apple. This accessibility has led to a surge in trading. It's not uncommon nowadays for people to check their portfolios or even make trades during their lunch break or while waiting for the bus. The barrier to entry has never been lower. But here's the catch. While these apps have made trading more accessible, they haven't necessarily made it easier to profit. In fact, the ease of use can sometimes lead to impulsive decisions or a false sense of simplicity. It's crucial to remember that behind those sleek interfaces and one-tap trades, there's still a complex market driven by countless factors. So while I'm all for the democratization of finance, I always emphasize the importance of education. These apps are tools, and like any tool, they're most effective in the hands of someone who knows how to use them properly. So if you're thinking of diving into app-based trading, make sure you take the time to learn about the markets, understand your risk tolerance, and develop a solid strategy. Fact number 7. Now, let's talk about something that every trader needs to be acutely aware of: risk. Here's a sobering statistic that might surprise you. Studies suggest that about 90% of traders lose money in the market. Yes, you heard that right. The vast majority of traders end up in the red. This isn't meant to discourage you, but rather to emphasize the importance of education and proper risk management. Trading isn't a get-rich-quick scheme. It's a skill that takes time, patience, and often quite a bit of trial and error to develop. So why do so many traders lose money? There are several reasons: lack of proper education and understanding of the markets, poor risk management, risking too much on single trades, emotional trading, making decisions based on fear or greed rather than analysis, trying to be in the market all the time, instead of waiting for good opportunities, failure to adapt to changing market conditions. The good news is that these pitfalls can be avoided with the right approach. Successful traders typically have a few things in common. They're well educated about the markets they trade, they have a clear strategy, they manage their risk carefully, and they maintain emotional discipline. Remember, even professional traders with years of experience and sophisticated tools at their disposal can have losing streaks. The key is to manage your risk so that the inevitable losses don't wipe you out, allowing you to stay in the game long enough to catch those profitable trades. Fact number 8. Let's dive into another fascinating aspect of the trading world, the way markets react to global events. In our interconnected world, markets respond to events in real time, often with dramatic results. Factors such as political instability, natural disasters, technological breakthroughs, and economic indicators can swing market prices dramatically. A single tweet from an influential figure can send stocks soaring or plummeting. A surprise interest rate decision from a central bank can cause currencies to surge or crash. Take, for example, the COVID-19 pandemic. When the severity of the situation became clear in early 2020, global stock markets experienced some of their worst days in history. The Dow Jones Industrial Average, one of the most watched stock indices, fell by nearly 3,000 points in a single day, its largest one-day point drop ever. But it's not all doom and gloom. Positive news can have equally dramatic effects. When Pfizer announced promising results for its COVID-19 vaccine in November 2020, global markets surged, with some indices hitting all-time highs. This reactivity is what makes trading so challenging and so exciting. It's not just about understanding numbers and charts. Successful traders need to have their finger on the pulse of global events, ready to react to the next big news that could move the markets. It's also why many traders emphasize the importance of staying informed. Reading financial news, understanding economic indicators, and keeping track of important events in industries you're interested in can give you a significant edge in anticipating market moves.